My name is Quan, and I'm honored to kick off today's program with a fireside chat with two important senior federal regulators, Bill Spaniel and Erik Belsky. Bill oversees supervision, regulation, and the credit department at the Philadelphia Fed. Erik, whom I have known from my DC days, is responsible for supervision, research, outreach, and policy analysis in consumer and the community reinvestment at the Federal Reserve. On the topic of community bank fintech partnership, Bill will share his insights from the safety and soundness perspective, while Erik from the consumer compliance angle. Then let's get started. My first question to Bill and Erik is, yesterday John Ryan provided a state regulator's perspective on the balance between the need for innovation and the need for risk management. Would you like to share your views on the same topic from federal regulators' perspective? Bill, can you go first, please?
Sure, thanks, Dan, and it's really good to be here, and thanks to the CSBS and the Philadelphia Fed for putting this up and for all the partners we've had. So I actually thought John had a really good comment that it's a balancing act, right? And clearly in this day and age and with COVID, innovation is becoming more and more important to the financial services industry. And as many people have said, it's really the pandemic has accelerated that in terms of our ability to reach customers in mobile platforms in an innovative way. So I think clearly innovation is going to be at the forefront of financial services for the next years, even more so than it has been. At the same time, there is a risk management perspective to this. And I think as many people set out, when you partner with anyone, it is truly a partnership here. You're not really contracting. It's not an arm's length. You're partnering here, and your reputation is linked with the partners you have. And so that does require a fair bit of risk management and a fair bit of knowledge. Although I think while some of the ways we're delivering this innovation and the tools we're using to deliver the innovation are different and certainly pose some risk, what we're doing essentially is still serving customers. And that risk management knowledge is embedded in these, whether it's lending to a car dealership for somebody to buy a car, or online through one of these service providers, or online through one of the fintechs. The risks are the same and the underwriting is the same. And I think banks have a good knowledge of where they are. This is just a new mechanism, a new environment. And I think innovation is coming to the forefront in many ways in financial services. But clearly, our standards around risk management should remain the same to protect the organizations and the consumers.
Great. So, Erik, do you agree with Bill?
I certainly do. And I'd also like to add my thanks to the Philadelphia Fed, to you, Dan, for moderating this, and to everyone who's joined us wherever you are, where we are down in Washington, D.C. It turns out to be an unusually chilly, kind of frosty day. But yeah, I agree with Bill. I think very clearly the pace of innovation has picked up, interest in innovation has picked up, the number of firms that are offering innovation has proliferated, and for lots of banks, that's going to present opportunities for them to serve their customers better, to be more operationally efficient, and they're forming partnerships to do it, sort of like the logical outgrowth. I guess the way I think about it is that the two really are in no way incompatible. Banks, from my perspective, are, after all, in the risk management business, and opportunities to serve their customers is what motivates them and forms the core of their success. And I think they can both be advanced, in fact, through innovation. Of course, firms want to innovate and, of course, must do so in a way that manages risks appropriately. That's what they, as I said, are in the business of doing. And I want to emphasize that the Federal Reserve supports responsible innovation. That's why we're doing a lot to understand the uses of fintech, including in the consumer and small business spaces, which are areas that I have responsibility for. We're looking at both the opportunities and the risks fintechs present in all phases of the credit life cycle, and we're looking at the range of options for bank partnerships, including customer-oriented partnerships where a bank selects a fintech partner to provide a product or service that enhances the customer's banking experience. As I said, operational technology partnerships that improve a bank's back-end operations. That includes partnerships that enhance efficiency and effectiveness of the compliance with regulations and the conduct of regulatory functions, and banking as a service partnerships where a bank combines its financial infrastructure with a fintech partner's user interface. So what does it mean for the Fed to support responsible innovation? Well, for starters, we've offered office hours so banks and fintech companies can ask us questions, and we can better understand where there may be questions they have that we can address on the spot. And sometimes they lead to us thinking about ways we might be able to revise our guidance, or through outreach to make things clearer, like webinars and presentations at conferences and preparation of newsletters. So, we basically want to support innovation while ensuring banks have the information they need to manage risks well. And that means issuing guidance so that banks understand their supervisory expectations and benefit from ways that regulators can help clarify risks that must be managed. A great example of this is the alternative data guidance that we put out, which we specifically laid out some fair lending risks, potential fair lending risks, and steps to help understand and mitigate them. It means, highlighting things that we think can help mitigate risks. And, lastly, I guess I'd say, because so many banks are forming partnerships, we're in the process of updating our guidance on third-party vendor management and working with other agencies to do so on a consistent basis. So I think these two, things are things that I think of as just part and parcel to the way banks operate. They manage risks and they serve their customers.
This is great. Thank you very much for the thoughtful answers. So every financial institution is faced with the opportunities and the challenges posed by financial technology. And Bill, as you mentioned in your remarks about the digitization of the financial services, really accelerated by the COVID-19 pandemic. My colleagues at McKinsey last year, they published a article. They basically offered a slew of solutions for banks to deal with financial technology or fintech, so they can acquire, they can compete, they can partner, or they can simply ignore. So in light of the theme of this conference, do you believe to partner with fintech firms is critical for community banks, not just to survive, but to thrive? And why not? Erik, you can go first this time.
Okay, so as I said, I think the Fed has a strong interest in seeing technological innovations flourish because they do present a lot of opportunities, and at the same time, we want to make sure that consumer and other compliance risks they may present are well managed. And obviously, developing, testing, validating new models or uses of alternative data are pretty costly. So partnerships are certainly something community banks will want to explore as a way to take advantage of innovation. And partnering with fintech firms offers an opportunity, as I said, for them to innovate at scale without having to invest heavily in updating their IT infrastructure or hiring outside tech talent. I was just on a call with a lot of community bankers, and they were talking about, the challenges in just, hiring that kind of talent. So it often is times just cost prohibitive for them to do it. And by partnering with a fintech firm, they can obtain compliance technologies to identify suspicious transactions, as an example. Many banks can ensure they're not falling behind technologically, and they can continue to maintain their focus on aspects of the operation that don't require changes in the technology, and probably most importantly for community banks in particular, what they do best, which is maintaining relationships with customers and communities. So yeah, I think partnerships with fintech companies, when well managed, present opportunities to better serve customers, to do so more efficiently, and they can help with customer acquisition on both the deposit and lending sides of the business. Certainly technology can help community banks thrive when they fit well into their operational goals and their customer strategies and their risk appetites. When banks are confident in their ability to manage the compliance risks, these partnerships can make a lot of sense. All that said, I'd also note that the overwhelming majority of community banks are financially strong, and they continue to enjoy certain advantages over larger banks, that go well beyond the things that technology can help aid them with. And that's because they know their customers, they're steeped in their communities, and ways that can give them actually an information advantage beyond what's captured even in some of the more elaborated models that we're starting to see that are using interesting things like cash flow data. and it affords them advantages in serving their customers. When we survey small businesses in our small business credit survey, for example, small businesses consistently rate their experience with small banks higher than with fintech companies and larger banks. So I do think that technology and other factors may favor scale economies. Still, it's worth, I think, noting that small banks, when they merge with or acquire other banks, they're often able to both achieve a more efficient scale while remaining comparatively small and to benefit from the advantage of their community roots. So I think, it's a really winning combination when banks are working with partners to help enhance their ability to meet their customers' needs in ways that are well managed. And as I said, I think those are part and parcel of how banks do their work. Now, I'm certainly aware of the challenges in making sure that you're comfortable as a bank, that the partner you're working with as a third party, is managing compliance risks and in ways that they may need to as part of the the wraparound process.
And Bill, how critical do you think it is for banks to partner with fintechs?
So I think here in the 3rd District, we're primarily a community bank supervisor, and we think community banks play a critical role in the economy in their communities, and they clearly understand their clients. I do think it's critical that they give really important thought to all the things that you said the McKinsey paper brought it. Do you ignore it? Do you partner with it? Do you develop it? And fortunately, the environment that we're looking at now through innovation gives them all those opportunities to see what fits well, I think, as Jason said, with their strategic plan. So I view this as a real opportunity for community banks to partner, to provide services, or to choose what's best for them in terms of their business plan and their communities. I think, as Erik said, they're well financially able to move forward on some of these things with partnerships. They tend to be very resilient. And they tend to be very thoughtful around what their customers are doing. I think the fintechs provide them unique opportunities and unique information to even be more successful in their businesses. And as Erik says, these partnerships need to be entered into with some caution and with some care. But as he says, the agencies are looking at some third-party guidance. We're looking at some due diligence guidance. So I think there's a lot of opportunity here for community banks to even further bolster their relationships with customers, their outreach to institutions, their efficiency behind the scenes. And I think it's a really good opportunity for them to consider a wide range of partnerships. And I'm encouraged over yesterday's conversation that the fintechs are actually engaged in a wide, whether it's payment services, lending, deposit gathering. I think it does provide for some unique opportunities and some unique partnerships among community banks and the fintech community.
Thank you. So Bill and Erik, both of you, excuse me, both of you have mentioned the third-party vendor risk management framework. I think this is really extremely relevant to this conversation here. So the Fed has existing guidance, which is very important to ensure safety, soundness, and the consumer protection. But at the same time, many banks and fintechs also feel quite overwhelmed when they try to partner with each other. So the process can often take too long. It can be extremely resource intensive, and a lot of the due diligence work is, in their mind, redundant, especially when a fintech is trying to work with multiple banks. So what, if any, changes the Fed can make to improve the process while still ensuring safety, soundness, and consumer protection? Are there opportunities to work across the different federal agencies or even with states? Bill, can you provide your perspective from the safety, soundness perspective? Then we go to Erik from the consumer compliance angle.
Sure. So I'm happy to say I think the agencies are thinking about this. As a matter of fact, we've got a publication called Community Bank Connections, with Governor Bowman has an article in. And her article, which was just released a few days ago in the latest issue, goes to the efforts we're taking on an interagency basis to revamp the third-party vendor risk guidance, to consider fintechs, to actually come out with maybe a due diligence toolkit to help bankers think about what due diligence they should go forward. And I think we've got models in the supervision side of the house to provide some guidance here. Again, we want to be cautious. We never want to endorse any product. We never want to endorse a partnership. That's a responsibility for bankers to take on, and they should take that seriously in terms of understanding what they're committing to and what their obligations are. I think we can, however, offer perspectives, we've got a service provider program, and significant service providers are examined by the federal agencies, and those are made available. So as fintechs begin to mature and these relationships mature, I think that's something we can give some thought to as potential models and others. I think also the conversation yesterday where there was a consortium of community banks that got together. There are challenges with that, but it can be done. And again, that goes to potentially relieving some of this burden. So I think we're in the middle of trying to address many of these issues, and there is work at the interagency basis on this, and so more to come on that. But I think, as Erik has said, we want to foster responsible innovation and be open to these ideas as we go forward. And I think as the relationships between banks and fintechs mature, and as fintechs mature in terms of what they're providing, the regulators will be cognizant of that as we move forward.
Great. And Erik, what's your view from the compliance perspective?
So, very similar. So Bill's a little modest. He's leading a lot of our system work around community banks. So he's thinking a lot about these, as am I, about, the challenges that all banks face with third-party vendor management, but in particular community banks. And so, we're clearly looking at this. Governor Bowman, who has a very strong interest in this area, is working very closely with us and challenging us in this area. So I think it's important, and we do this when it comes to third-party vendor risk management, as we do many things, together with our safety and soundness colleagues. So, when something does come out on this, and we work with other agencies, as you know, because we'd like to bring greater consistency to third-party risk management guidance, that we're working together and we have similar aims. Vendor risk management is really essential. And we know that banks have lots of questions about it and wonder if there are ways we can make the process more efficient, or they can band together to make it more efficient while ensuring that they're effective, which is what really they want and we want. So, we know it's challenging for smaller banks, as I said, to make the investment they need to do the appropriate due diligence up front before they select a partner, and then in monitoring activities conducted by the partners on an ongoing basis, it can be significant. So, our reserve banks are available to help answer questions along the way. But as Bill mentioned, we're working with other agencies to develop this guidance so that it's consistent, it's updated, it's strengthened to reflect, what's going on and what we're understanding to be questions we're getting from banks, particularly small banks. We are working to look for ways to create more of a vendor due diligence guide that would be, kind of more of an active tool that banks can use that, builds on our existing supervisory expectations, but gives people things like sample questions that they could pose, to their prospective fintech partners, and really try to flag the really key considerations when banks get responses back from the firms to those questions, and kind of examples of documents to collect in support of their due diligence. So when we come in and look to see what due diligence is done, they've got all that very clearly there. So we think there's a lot we can, in fact, do in those areas, and we're committed to doing it. And then the third bank is the one that Bill mentioned, which is leveraging the work that we do in the service provider supervision programs that we do in the largest firms. So, we continue to want to make sure that banks have access to those kinds of reports, and we're proactively sending reports to community banks to sort of try to make it easy and clear for them to have reports on banks they're working with. So those are some of the things that we're doing, and we think it's important for us to do those things as a way to help support responsible, well-managed innovation.
Oh, so that's very encouraging. So actually, I just wanted to maybe do a little bit of deep dive on the ways to help streamline the third-party vendor risk management process. So there have been a lot of conversations, from the industry side. There are conversations about forming some kind of neutral, trusted third parties that can perform the due diligence for any vendors, so that banks can rely on that the due diligence or the annual audits to when they onboard a fintech, so they don't have to do everything over and over and over again. So there's a few large banks plus I think TCH, they have formed the entity called TrueSight. So they're testing and they're piloting some programs. And I think the challenge has always been, as Bill and Eric, you mentioned, you guys cannot endorse any such things. So how do companies really walk the fine line without a government's endorsement, but still rely on those reports to when they onboard a third party? And I think it's really interesting to see, and that's critical when banks talk to their examiners, because that's where communications sometimes can break down. The supervisors may in DC or in at the Philly Fed, they may have certain policy orientations, whereas there's some sort of communication breakdown between the headquarters and the line staff.
You want me to take it or Bill first?
Eric, you go first.
Okay. So, listen, we do so much to try to really bring consistency to our supervision. So, we're always working on that, to your last point. In terms of, the broader sets of issues you're raising here, it's another great question. I think, given limits to regulators, resources, and authorities to supervise financial firms, it's unsurprising to me to see the emergence of firms that are offering products that provide due diligence on individual fintech firms and annual audits of these firms. And you have, some banks banding together to do this. I think, of course, these third parties are themselves third parties. And so banks need to do diligence on those providers to ensure that the vendors' due diligence and auditing of fintech companies, are sufficient. And so, we understand the challenges in doing so. And we think that there are these, potential opportunities to get to some kind of scale in these things, that, industry is already moving in that direction. The market is, sees that and is working on it. I'd also note, which I think, most people on the call, if not everyone, knows about. Last July, the FDIC published, a request for information on standard setting and voluntary certification for models and third-party, providers of technology. So, their stated goal in doing it was to promote efficient and effective adoption of technology at FDIC supervised banks and savings associations, particularly community banks. But of course, the FDIC and the Federal Reserve share those goals, as do the other federal financial regulators and supervisors. And they specifically, in the RFI, sought input on the advantages and disadvantages of establishing a public-private standard setting organization. So that's yet another, model that's, certainly out there and being looked at. So we at the Fed are reviewing the comments that were received to the RFI and are looking forward to conversations with the other agencies on what we can learn from it. So, you have the market taking steps to do this. You have banks trying to figure out what they would need to do to wrap their mind around the strength of those market-based alternatives in achieving the due diligence that everyone's seeking. And then there's this idea of potentially some form of public-private partnership that could potentially emerge. So those are just some of the things I think on the table.
Awesome. Bill, what's your view?
So I would agree with Eric. I think these are all really interesting concepts and things that we should consider, that we want to hear about, that the industry should look to do, and that community banks and other banks should look to do. And look, there are examples of this that work today. Appraisals are one way, right? There's a number of ways where we ensure that appraisers and appraisals are correct. We have a supervisory emphasis on that on occasion when it's necessary. But I think all these are viable alternatives that we should consider in terms of this innovation. And they need to be considered from what advantages they offer to community banks, what they offer to fintechs, and then how as we as supervisors can take either some level of comfort that they are good substitutes for due diligence as we currently know it today. But all those things are viable alternatives that should be pursued.
Great. So that concludes our fireside chat. I would like to thank Bill and Eric again for sharing their insights.